Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
All right, good morning. The show's Money Matters with Greg. I'm Greg Farrall, CEO and president and owner of Farrall Wealth. It's a wealth management firm here in Valparaiso, Indiana. We are broadcasting today on podcasts, wherever you pod, but also on WVLP 103.1 FM. Excited to be back on the radio here locally in Valparaiso, Indiana, but also broadcasting throughout this World Wide Web thing that is throughout the world. So a number of people listen in from all over, and wanted to welcome in John Farrall, a new addition to the Farrall Wealth team, and then also my esteemed brother. Very excited to have him as a part of the team, and welcome, John. Just want to, if you want to say hey to everybody out there in the world, give a shout out.
Hello, welcome to join for the first time, first of many.
Yes, first of many, I hope, for sure. Very excited to be able to do this today and have John on. John is very well versed in the world of investments, and that's why we love having him on board. That's what we wanted to talk about today, was really just talk about the market and what has happened here in the last few weeks, the last month. People are concerned, they're worried, and we thought it prudent to talk about some of the things that have happened here in the market overall. So we're tagging this podcast as the uncertain podcast, because the market loves certainty. And even if Washington and the people in Washington can not agree on anything, the one thing we can certainly, if they don't agree on anything, it's certain that they will not agree. And usually that is very good for the market because nothing gets done. Right now, we're seeing the opposite of that, and things are very uncertain. We don't necessarily know where things are going. So I wanted to bring in John, talk about some of the things that have happened, where the market is now, where we look like we are going, talk about some of the names that have been out there in regards to some of the S&P 500 and some of the companies out there as far as reporting, and just have John kind of talk about some things. I'm going to ask him some questions, and if you in the audience want to email us, you can email me at greg@farrallwealth.com with any questions as well. And we will have multiple questions on this show, but then also in the future. So thanks again for being here. Again, WVLP 103.1. Last housekeeping thing, the opinions voiced in the podcast and are of general information only and not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Again, Money Matters with Greg. We're excited to be back here. I think it's 152nd episode. So John, welcome. John, what are you seeing out there in the market?
Well, what we're seeing, at least recently in the market, is how you started the podcast there, Greg, which is some uncertainty. And the number one uncertainty, not to get into too much politics, but it's politics. It's tariffs, and it's how much, to where, for how long, just as a bargaining chip. Longer term, President Trump has said that, hey, it's got to be fair trade, and we are all for fair trade. We're also open for open trade. Unfair with tariffs is like somewhere in between that. It's not fair per se to have 200 or 300% tariffs on certain things, because certain countries want to protect their internal industries, and yet we have that globally in places across different nations. And nirvana, no tariffs anywhere on anything, and equally no tariffs on either side. We don't have that a whole lot of places either, to be honest. And so, you know, President Trump has said he's going to do what he promised in getting reelected, and he's moving forward on making trade more fair. Now, you know, that's the uncertainty because we have 25% tariffs on aluminum in the morning, followed by retaliation, followed by 50% tariffs, followed by retaliation or backing off, and then suddenly we'll just pause for 30 days on no changes to tariffs. And that's the kind of uncertainty that I think it's not just the market, it's the companies also don't like that kind of uncertainty. And you've seen some shifts, and we're going to get into CPI and some inflation numbers and some earnings trends. But you've seen some shifts in supply lines. I mean, others can read the tea leaves and they can move production to some degree or supplying to some degree. There's an awful lot of buying, particularly of copper and some other raw materials, just before tariffs, just before Trump, was inaugurated there in January 20th. So February got pretty choppy. March has gotten choppier, and most economic indicators have a 2 to 3 month lag. So we're just starting to see some of those, um, you know, I'd say import export, like turbulence kind of numbers, just like a hurricane. A hurricane disrupts the normal pattern of people going to work, coming from work because they can't get to work. Same thing with what we're seeing. We're seeing a little hurricane in global supply chains based on tariffs and what we think might happen or what others might think might happen. And it's crowd psychology at this point. What you think might happen is you want to shore up your supply chains against your competitors, move to domestic manufacturing as best you can. Everyone else is doing that as well, and contracts are being bid for some of these things, and they're being bid up. So we're seeing price inflation.
And when consumers are uncertain, they typically turn negative about their views, and that's really been seen in the economic indicators. In February, the University of Michigan household survey that we rely so much upon, it really monthly plunged to 64, was just below 65, and that was a tumble of 9% from the January level, and then down another 12 from the December level. So it certainly feels like the sentiment is really negative, and that's why in the market we've seen these 500, 600, even 1,000 point drops where people are just saying, "Look, I'm just going to sell and get out and just see where things read the tea leaves, run to conservative investments, and just circle the wagons a little." Certainly seeing. Are you seeing the same sort of thing out there?
Well, it depends on where you look, and not everything is negative. Actually, one of the things that's been positive, again, back to some of the sentiment and some of the surveys, we had almost a 50-year low in the Small Business Economic Survey, the NFIB, the Optimism Index, almost a 50-year low back May-ish. And we've seen close to a 20-year high just recently hit. So a big swing in small business sentiment to the positive. Now, hiring challenges might frustrate kind of some Main Street owners as opposed to the big firms, finding qualified workers and some other things that, frankly, again, with politics, if those workers are undocumented and potentially being deported, there's going to be some more changes for small businesses in the next 3 to 5 months. But a big swing positive. People, as clients tend to only look at their statements month to month or quarter to quarter. But it's clearly in the news that the markets have corrected. We're as far as I can tell from, right this second, we're down about 8.6% from our high that we just hit on the S&P of February 19th. So we're not quite 1 month into a correction on the S&P. I was looking at some other, just kind of drawdown numbers because my point here is sentiment is often correlated with, well, how are my investments doing? And my investments have been doing extremely well since the low of COVID back in 2020. And we're coming off two back-to-back up 20% years in the S&P 500. So we're coming from elevated space. Any kind of pullback, any kind of drawdown feels kind of catastrophic. And I think we're seeing some of that like in the near term. But pullbacks are typical and to be expected of 10%. We see that on a fairly high frequency. We just haven't necessarily seen it. Um, and
It's
when
been
we're
a
seeing
while.
it, yeah, it's been a little while. And even when we see it, they all feel better in the rearview mirror. None of us enjoy a drawdown as it's happening. Um,
No.
that's for sure.
No, but it does seem with all the drawdowns we've seen, and you and I in our careers have seen as far as value. I mean, I was devaluation of the peso all the way back to dot-com boom, dot-com bust. Same with you. You try, you've been through all of that. 2008. You took a pandemic. I mean, we traded through a lot of things in our life. This actually feels like, as painful as it is for looking at a statement, it feels like a very healthy um, drawdown. Added volatility. Obviously, VIX has gone from 14 to 28, so people are nervous, but that's very normal, and it's very healthy for the future of the market. This has not been. Um, It's not been crazy. It's just been sort of a slow, methodical down draft based on news, based on concern, based on, again, uncertainty in the markets. Is that kind of what you're seeing here, or are we in panic mode?
I would say it depends on what you're looking at. I was, I was looking at some things here, and one of the things that we face now that is a little different, maybe this time it's a little different. Those are always dangerous things because history
Right.
you know, usually is the way to go with your investments. But in this particular drawdown, we have a fairly concentrated S&P 500 and a fairly concentrated QQQ, triple Q, or the NASDAQ 100. As you mentioned, the VIX index, the VIX is the S&P 500 volatility index, which is market cap weighted. So it by nature is also concentrated toward the top names. And the Mag 7 stocks, the top names, um, are a significant portion of these indices. I think as I looked just today, they're right around 40% of the NASDAQ 100, and they're somewhere around 23% of the S&P 500.
Which is huge. I mean, that's why we've had such a run up in the S&P the last couple of years. Is these, the Mag 7 have just taken off.
So yeah, so again, it sounds kind of traditional to say, but it is true. A more diversified portfolio does weather these drawdowns better.
Yeah.
I was looking at, the S&P is down about 8%. The NASDAQ 100 is down 12%.
Mhm.
Both are down from their peak the same amount of time. So both hit a peak just February 19th.
Yeah.
Just February 19th. It's not been that long
Yeah.
to be in this quote drawdown.
Just
And
so
the
the audience knows, today's March 12th.
Yeah,
So
March 12th.
not even,
So
not
we
even
got we're not even a month in. We're 20 some days in.
exactly.
However, on the other hand, one of the Mag 7 stocks, Microsoft, hit its all-time high 250 days ago, back in July, and is down 20%.
Yeah.
Another one of the Mag 7, that's down almost 50% from its high, set its high in December, and that's Tesla. And that might be a little bit more politically related than one would like to think if they're just a fundamental earnings type of driven type of shop. And we tend to be that. Tesla's earnings have not gotten cut in half, and it doesn't justify the stock being cut in half. But the CEO, Elon Musk, is, uh, been pictured an awful lot doing his job for the government, not necessarily with his emblem as CEO of Tesla.
Right.
And it's bothered sentiment again. And it certainly doesn't help that Tesla's look to be a political football lately. With again, it's just here in March, and this past weekend we had various demonstrations, some of which became violent at over 50 Tesla dealerships.
Mhm.
So, that one might be an outlier on the downside. Um, but the fact of the matter is the Mag 7 stocks, even excluding Tesla, Nvidia's down 23%, Google's down 20, Amazon's down 18, Meta's down 16. Um, that could very well be a buying opportunity
Yeah.
longer term. However, these stocks have flown pretty hard, pretty far, and a pullback in these stocks is not unexpected. And we're seeing closer to a bear market pullback in the
Yep.
Mag 7. 20% is the definition of a quote bear market. Um, and for most of them, they are somewhere in the 60 to 85 day range. So they all kind of hit highs there in the I'll call it the Trump bump, from November 5th until mid-December. We saw markets go up pretty much in a straight line. And most of these stocks hit highs either there, 1217 or 1218, or just recently here in February. So we're off highs. And if we look at percent off lows, the lows are all the way back in COVID in 2020.
Right.
They're
Right.
up.
Well, just a few months ago, I had clients, why don't we own this or why don't we own that? It's because it's run up so much. We've been sellers, so we don't own it right now. And now, people are concerned like, well, I don't want to get in now. It's like this is the time. I mean, this is when fear is. This is an opportunity, if anything, to if you want to add exposure to your equities. Um, I'm a huge fan, as I explained to many people throughout, just the advising world. We all like to shop at a discount. I love going into the store and getting 20% off. And I mean, that's where we are. So what's wrong? Is the product changed so much that it's not something I want, that I expect 30% off or even 40% off? Maybe. But if you're running a diversified portfolio and you're in multiple different asset classes and owning many, many things as modern portfolio theory that we believe in, there are some things that have done really, really well this year. It's not just the S&P. I mean, the S&P right now, for the year is down 4%. I mean, it feels like it's down 20 the way the sentiment is. But we were just up. I mean, we were just up, what, 3.5% for the year, and the year had just started. So you look at you look at what's actually down for the year, and it's not, you know, awful. It's just painful. Um,
I'm not even sure, those are absolutely the correct, ways to think about it. I'm I'm not even unless we're talking single stocks, I'm not even sure it's all that painful.
right.
But sectors tend to be a little bit more volatile than singles than the major indices
Yeah.
because again of a concentration. So if Amazon is a big proponent of, proportionally of the S&P or the Nasdaq 100, it's a huge contributor to the consumer, sector as far as consumer discretion, which is down 14% year to date. So you're spot on. S&P down about 4, um, Nasdaq down around 9, small cap also down around 9, but consumer discretion, that's kind of Amazon's territory, down 14,
Mhm.
and technology in general down 11.8. That's the Nvidias and others of the world. And what you've seen is kind of like the the more defensive plays actually, provide a lot of stability. Financials only down 1%. Uh, Utilities actually up 2.5%. Um, those are places that we kind of rotated into and or trimmed what was large gains toward the end of the year and this early this year. So
Yeah.
it's kind of like not unexpected that, the PEs of the Mag 7 would get price to earnings ratios on forward earnings, PE, that those would get compressed a little bit because excluding the Mag 7, the S&P forward PE ratio was, only around 18 to 19 times. So it wasn't that high. But if you look at the S&P with the Mag 7, it was closer to 23 times. And if you look at the Mag 7 stock, they were closer to 28 times,
Yeah, which is expensive. I mean,
which
it's
is pretty expensive. I
yeah,
mean,
that's
just
like going in, going into Saks Fifth Avenue or any really, Tiffany's and asking for the most expensive thing on the rack, and don't give me a discount. I want to pay full price. And that's
right.
kind of what we were feeling like for sure. Real quick, just want to mention the show's Money Matters with Greg. I'm Greg Farrell, CEO and president of Farrall Wealth. It's a wealth management firm here locally in Valparaiso, Indiana, in the Midwestern charm of a great town. We work with clients nationally. We're licensed in 21 states. Um, and talking the markets here with John Farrell, and really just try to address what's going on out there in the markets, just because we've had such a drawdown. The show's also broadcast on WVLP 103.1 FM, so want to be able to station identification overall. John, as we kind of wrap up here, what are your thoughts about next steps here as we talk about, it is just March. Um, I know we were up for the month in January. Historically, January is so goes January, kind of so goes the year. Um, maybe you could talk about that as far as like where we see, things in the future. We're certainly not, um, I think as a group, we're certainly not scared of equities. I think it's more of an opportunity than anything else. But you want to talk about kind of, what your thoughts are for the rest of the year here?
Certainly. And one other kind of just, for the record, I'm down here in the Tampa Bay area as, Farrell Wealth is expanding and growing. And that's, kind of like with the markets. We're paid to figure out where the growth is and where growth is at a reasonable price. And we were kind of talking about some things that are priced maybe for perfection and whatnot. Again, Greg, if you want to hit it, this doesn't constitute any kind of solicitation on any kind of sale on an individual security at all.
Right.
But I would say the greatest risk here, and one of the phrases might be, march in like a lion, right? Out like a lamb. We're used to that across the Midwest, and we've certainly had some nice winter storms here lately. But I'm kind of hopeful that that's the case. The January barometer was up 5 or so. We finished January up almost 5% or around 5%. That tends to be great for the markets. However, we've given all that back and we are down for the year. So climbing out of the hole and making the year a positive year, I would say those estimates of a triple 20% in a row for 3 years in a row, those have I I wouldn't go there. I wouldn't go there. But I would think that, so far we're seeing only modest earnings revisions. We're only seeing modest fundamentals. We're basically seeing turbulence. The one thing that was said on the major news here recently, and it is something to kind of bear witness to, is we are invested in corporate America, corporate earnings. However, corporate America, of course, you know, lives off of what the general economy is doing, and there was an awful lot of stimulus to the economy. Fed kept rates very low, raised rates just recently. Has been on a pause, so they're not seeing a sign of a recession. And whether or not recession starts to kind of show up in some of the numbers, so far, I don't think it has. The consumer sentiment numbers might still be a lag effect from various policies from previous administrations or just what was going on. And we had some major disruptions to the economy. I can attest to that. Three hurricanes through the Tampa Bay area within, 2.5 months certainly has dampened the Southeast economy quite a bit. And the Atlanta Fed has seen, some major changes there. But I would say for the average listener here, one of the greatest risks is something that we talked about internally just this past week, which is, look, if you stay fully invested and you're a consistent saver, over time, your portfolio does the best. If you're an inconsistent saver and you try to pick and choose, or, worst, you basically get scared into cash, when things get rocky and you never come back out, that's when you do the worst. So again, asset allocation and having a disciplined investment philosophy are paramount, especially in times when things do go off price. And you don't know how long the sale is going to last. We don't know if this is a, quick 7-week sale, or this is going to be closer to the Microsoft situation, a 9-month sale. There's an old adage, Greg, that you're well aware of as a trader. They ring a bell at the end of the session. They don't ring bells at the high of the markets. They don't ring bells at the low or the bottom of the markets either. Picking tops and bottoms is nice in theory, but staying consistent and maybe upping the allocation here, toward what is not cheap for a reason, just cheaper than what we were used to, is a great idea. So rotating into equities versus rotating out into cash. Warren Buffett said it well, and it comes to mind. Strive to be greedy when others are fearful, and fearful when everyone's greedy. And everyone was pretty happy and pretty greedy, toward the end of last year, which is one of the reasons why we quietly, raised some cash and moved some things around away from, the stocks that had done so well for the last year or so.
Yeah. Well, we can be certain right now that things are very uncertain, for sure. And that's until we work through this paralysis, really, not only the business side, but on the political side, just trying to figure this out. I think time will tell. Again, very, very prudent advice. Follow good names, research good names, follow those stocks that you want to buy, that you want to own for the long term. Diversify your portfolio. All those lessons are really, really prudent right now and coming to fruition where, for a while there, just everything went up. So that's not the case. We can certainly attest to that. Just be calm, carry on, and invest wisely for sure. John Farrell's here, been joining us here today on Money Matters with Greg. John, I want to thank you for being here. Thanks. Certainly look forward to this, in the future.
Sounds great.
All right. Thanks again, John. And the show's Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrall Wealth. It's on WVLP 103.1 FM here locally, and then anywhere you pod as well. So thank you for being here and being a part of this. And if you have any questions, feel free to email me at greg@farrallwealth.com. It's like Will Ferrell, but he spells his name wrong. It's Farrall. And again, just as a reminder, the opinions voiced in this podcast and this radio show, are for general information only and not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments might be suitable for you, consult the appropriate qualified professional prior to making a decision. Thank you very much for the lawyers and the compliance department. John, thanks again for being here, and we'll catch you again on the next show.
Thanks all. Take care.
Yeah.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.